So
Got it.
perfect, we're good to go. So John, thanks for coming in. John is a go-to for me when I need wisdom. And so I'll just quickly explain what's gone on. Is I had a listing that just fell apart, the sale, the transaction, and it's because the buyer was being charged an additional prepayment penalty when they were reducing the size of their mortgage. And the dollar amounts really jumped out to me as being massive and different things. And so I reached out to John, and John, being the wealth of information, because John's a mortgage broker, and we'll talk about that here in a second, John was able to bring clarity on that and also brought up a whole bunch of things that we need to consider when heading to the mortgage. And so I asked if you wouldn't mind coming on and just sharing that with us today. So thanks for coming in, John. Can you tell everybody who you are?
Yeah. Thanks, Jason, for the opportunity. So my name is John Cliff, and I'm an agent for the Sky Financial, the Mortgage Centre. And I've been in the mortgage business for probably over 20 years. I've worked independently, and I've also worked for a major bank. So I've seen kind of both sides of that fence. And, my goal really is to educate people about mortgages and how they work so that they can make, more informed decisions and try to grow my business that way.
That's perfect. And actually, to touch base on one of the things that John had mentioned yesterday that I didn't think about, what do you think people pay? You basically had said there's a dollar amount associated with the amount of errors that we make in our mortgage. And I forget how that went yesterday.
Oh, yeah. Well, actually, I was talking to a friend in Vancouver who's got this really convoluted multi-product mortgage with one of the banks, and one of the reasons they do that is all the little bits and pieces come up for renewal at different times, and so you can't really switch the whole thing over without breaking all these subcontracts and so forth. And he was saying, he just kind of ignores it, doesn't really look at it that closely. And, I think people probably waste, I would say, if not, multiple thousands and thousands of dollars over the life of their mortgage by not really paying attention to what's going on inside of it.
Yeah,
if you have a mortgage for 20 years and you're looking at, maybe misjudging $3,000 a year, that's $60,000. It's a lot of money.
Yeah, that was a part that surprised me. The very first time that I realized that when we get a mortgage, over the entire life of the mortgage, we probably spend as much in interest as the original principal amount of the mortgage. So if we got a mortgage for 500 over the next 25 years, we've probably paid close to 500 in interest.
Yeah, I mean, there's the sun again.
No worries.
It is quite a major component of it, and I think the main issue is people are so focused on getting the house, and they just think, well, I'll just get the money from the bank, and the lawyers will deal with everything, and I'll get the keys to my house, and everything will be fine. But just like looking after your body, you probably should go to the dentist once a year. You should probably see your doctor once a year. Well, you should probably open up the mortgage once a year, because from a financial perspective, it's the largest financing you're going to do in your lifetime. And it's fairly easy to open it up and look at it and figure out ways to save money. I think most people are just so focused on the rate when they're getting a mortgage because they think that's the cost of the mortgage, but that's just a small component of the cost of the mortgage, as your clients found out the hard way with the penalty. And that's usually when people find out about the penalty, is when something goes wrong. They don't think about the penalty up front.
Yeah, so let's jump into that then. So that's a perfect segue. So when somebody is going and getting a mortgage, like you said, we're generally focused on how much we can get. Yeah, sorry, that takes up.
I can't stop the sun. I'm sorry.
It's all good. One of the major focuses that people have is how low of a rate can I get?
Yeah.
Now, is it fair to say that everything comes with a cost?
Well, there's more than just the interest, the cost of the mortgage. People get fixated on the lowest rate, but they don't think about what are they going to do in the next 5 years? Is anything going to change in the next 5 years? And I think, I don't remember the exact stat, but on average, Canadians change their mortgage about every, I think it's 2.5 or 3.5 years. And yet we all sign up for these 5-year contracts. And that's another thing people overlook, is they think they're getting a loan, which they are, but what you're really doing is you're signing a 5-year contract.
And so when
And
somebody has a life-altering event and they want to change, right? They need to downsize, they need to upsize, they have too many kids in the last 5 years. There's death, divorce, there's job loss, all that sort of
a
thing.
number of reasons, yeah.
They need to alter the contract, or they need to move. And when they do, they head to their bank. And can you explain basically what the prepayment privilege or penalty is?
Yeah, so like if you break it, when you sign the contract, even though you don't read it, and that's a whole other can of worms, because the first time you see the contract is at the lawyer's office, and you're 5 signatures away from getting the keys to your house. So you're excited, you're nervous, the contract's that thick, and sign here, initial here, oh, here are the keys. And you walk out and you're just elated, right? If you'd read that contract, or at least explored that contract before you chose that lender, you may think of it differently. But so basically you're breaking this contract, that you've agreed to pay a certain amount of interest over the next 5 years, and halfway through you're saying, you know what, I'm going to renege on my side of the contract. So in the contract it says, okay, you can do that, but there's a price to pay, and that's called the penalty. And various lenders use various formulas. There are 2 basic formulas that are used, and they always choose the biggest penalty out of those 2 formulas that they can find. And that's usually when their first experience with a penalty is when it turns out that they have to pay one. Whereas we think your first experience with a penalty should be before you even choose the lender.
No, and that makes sense. I'm a big believer. See, I hate playing Monopoly on Friday night and not knowing the rules of the game, right? Are we going to have free parking as a place to be able to win a whole bunch of money? Or is free parking a place where it's just literally just you get to stay on an empty square?
Yeah, boring.
And so, I really don't care which way you're playing. I just want to know the rules of the game before we start. Yeah. And so when you mentioned that about the contract, that hits home for me. And so what I just heard is all lenders aren't created equal. It's basically every lender has different ways of calculating.
Well, there are basic methods that they use, but how they actually do the calculation will vary lender to lender, and they have different policies. Like there are some lenders that will allow you to port, but only if you pay the penalty. Who's heard of that? So that's why it's important we think it's important anyway, when we're first interviewing you, to ask you about your plans in the next 5 years. What are you planning to do? Are you planning to change jobs, move, have children, take on more debt, have to pay for it? Like what are your, and they want to know what the rate is. Okay, well, the rate you could end up paying a penalty that's so high that it would have been like signing up for a 7% interest rate at the beginning, even though it's advertised at 1.99.
Now, you would use the term porting. Just for the listener, in case they don't understand, can you explain what you mean?
Sure. So porting is you're basically moving your contract from one property to another property. So you're keeping intact the contract. You're still agreeing to pay that rate on that amount of money for the remaining term. You're just changing the underlying collateral, which is the security for that contract.
So basically what you're saying is I have house A. I need to move from house A. Let's say I have more kids. I now want to move to a bigger house, or COVID hits. We realize we're in chaos in our house because our house is too small and we're doing homeschooling and working and everything. We need a bigger house, so we're going to move. And so what I want to do is just take my mortgage from here to here without changing it at all. Correct?
Yes.
Okay.
Yes.
Now, so that is porting. Now, what my sellers had experienced is the buyer was actually downsizing and they had wanted to port their mortgage. And so just use round numbers. If you have a house that you bought at 600,000, and let's say you have a $500,000 mortgage, and then you go to buy a $500,000 house, would a bank just allow you to take that $500,000 mortgage and put it on the $500,000 house?
No, because then they'd be lending you 100% of the value.
Okay. And so then the contract says, hold it, if you're going to change the mortgage, you have to pay me the privilege or the penalty.
Right. So you, in that example, if the new mortgage is say 400,000, when you sign your contract, you agreed to pay interest on 500,000. Now you're breaking that and saying, oh, I only want to pay interest on 400,000 for the remainder of the term. So let's say there's 2 years left. So they say, okay, well, we'll let you do that, but you got to pay the piper. Because you agreed to pay interest on $500,000, not 400,000. So that's called a port and decrease, and there's a penalty associated with that.
And
But
so
but the reality is, ports very rarely occur actually, because it's fairly complicated to get approved for a port. You have to prove that you've already sold your house before you can get approved for the mortgage to get the new one. So it very rarely occurs. And some lenders, you can only port the exact amount over. You can't change anything. Maybe you want to change things. Maybe you want to stretch out to a 30-year amortization again. So if there's any significant changes, usually porting is too complicated.
now, are there certain banks and groups of banks that are more predatory in their penalties than others?
Well, I wouldn't say predatory, because you signed the contract. You voluntarily signed the contract. So the
So let's say more aggressive in the contracts then?
Yeah, well, the big difference we find is most of the major banks use posted rate to calculate the penalty. And other lenders will use either their posted rates are already discounted or they just use the contract rate.
So can you show me an example of what a posted rate today would be, and a an actual rate that they would use?
Yeah, I can pull up something. I did up something. I just got to figure out how to share the screen here.
Yeah, no problem. If you just scroll over the screen, there should be the green share screen up arrow. You may have to go back to our image.
I got it. Yeah, I got it.
Perfect.
Okay, so let me just go over here and is it sharing?
I don't have it. No.
Share screen. Oh, here we go. Okay, can you see that?
It's coming. There it is. Yeah.
Okay, so I just pulled this off the CIBC website.
Okay.
And nothing against CIBC, they're my alma mater, but this is basically to illustrate that there are differences in the way people calculate the penalty.
Perfect.
Can you see that okay?
Yeah, I can see it.
Okay, so here are their CIBC's posted rates. So the 1 year is 279, 2 years 289, etc. 479. Now over here, they're offering you a special offer. They're basically giving you a 2% discount.
Okay, so can you explain what a posted rate is? Just a quick definition.
It's basically what they publish.
So it'd be published on all websites, mortgage renewals, everywhere they put it. Okay.
But if you went to a bank and they said, well, we're going to charge you 4.79% on a 5-year fix, you'd walk out the door, right? So what they do instead is they offer you a discount, and you can see here special offers. So 2.79 is a 2% discount from posted rate. And most people go, oh, that's cool.
I'm
That's
saving
where they
2%.
get you. That's where they get you when it comes time to pay the penalty. So, and I'm going to use this rate as another lender would be offering this type of rate, like a non-bank lender,
Okay.
like say Amerix Financial or somebody like that.
Yeah.
And so the reason the bank is offering you this is because that's competitive. So we can make the assumption that this is the sort of the regular rate of all the other non-bank lenders. Does that make sense?
So it's not their posted rate, but everybody's offering the same sort of special rate.
Yeah, and some of them post these rates as well.
Okay.
And so let's say 2 years or 3 years into the mortgage, you need to break the contract.
Okay.
You lost your job, you're selling your house, whatever. So you need to break the contract. So the lenders are going to do two calculations. One is called interest rate differential, and one is called 3 months interest. They're going to calculate both of those and pick the higher number. So the example I've got here is on you've agreed to pay a $500,000 mortgage at a 5-year fixed rate of this 279. That's the contract you signed, okay? And 3 years into it, you need to break that contract. So what the banks do to calculate interest rate differential, they're looking at the difference between these two rates, 479 and 289.
Okay.
And so you're going to pay that difference in rate over the remaining 2 years because you've got 2 years left in your contract, right? So if we take the difference between 479 minus 289, multiply by 2 years times your 500,000, it's a $19,000 penalty. And I say posted rates here because they're using posted rates to do this calculation, right?
Yeah.
Now, the other way they'll do it is what's 3 months of interest? So again, they use the posted rate.
So they don't look at your current payment and say your current payment interest.
Posted rate. They don't look at your contract rate. They look at your posted rate. So they're going to calculate the 3 months interest based on this 479, even though you're paying 279.
Yeah, most people, I think, assume that when we talk about 3 months interest, it's the actual interest that they're paying, but not the interest they would have paid on the posted rate.
Yeah, so that's why you want to read the contract, or at least investigate it before you choose a lender. So that's about $6,000. So the bank says, you know what, let's delete this one because it's lower, and let's charge the 19,000. Okay, and that's where your friends ran into the problem there the other day.
That's a pretty big number, because if you think of people coming into a home, what is the average buyer putting down? It's got to be less than 20%?
Well, if you use the example of someone putting 5% down and paying a 4% CMHC fee, they're really, the loan is like 98% of the value of the home.
So they bought a $500,000 home. They
have a 400.
They put 25 down.
Yeah. So
then they paid the CMHC fee of 24,000 or whatever it works out to be.
Yeah.
And now they're actually being charged 19,000 to get out of it. So they've paid double their down payment on a 5% down.
Or worse, they can't get out of it because they don't have that money lying around. So you sell their house, they're underwater, they can't close on the transaction.
Yeah, and that is similar to the situation I understand these buyers are in.
And then now there's a domino effect because whoever was buying their house can't buy it, and the whole thing falls apart.
Yeah.
So let's look at a different example of what we call a monoline or a non-bank lender. And so 279 was the rate, right?
Yeah.
So when it comes the same time to break this contract, they do interest rate differential. So if you subtract the 289 from the 279, you're negative, right?
Okay.
So the interest rate differential is a negative number.
Okay.
So so in theory, they should pay you to get out of this, right?
Yeah, they're happy with you getting out of it. They want to give you a new mortgage because they're going to make more money.
Yeah. So, but it's negative. Remember, they're going to choose the higher of the two. So that
Yeah.
one's immediately a moot point because it's negative. So then they charge you 3 months interest, but at your contracted rate,
Which is
not this
what most of
rate.
us expect it to be anyway, but we didn't read the fine print, so it may not.
Right. So they toss out interest rate differential because it's negative,
Yeah.
and they charge you 3 months interest at this rate. So now you're looking at a $3,500 penalty versus 19,000. So the bank penalty is about 5.5 times higher. So what we try to encourage people to do is think about this prior to choosing your lender. Don't just think, well, I've banked at, such and such a bank for 20 years. They love me. They'd never do this.
I have all my savings and everything there. I've got stock there, John. What do you mean? They're going to
I'm a
charge me 20
shareholder.
grand to get out. They don't want
I'm
to
a share-
business. They're scared.
So, if you want to bank with this, then I would suggest you buy lots of stock in the bank because that's very profitable.
And so most of the time, if you went into your branch, so they're not going to tell you this, and they're probably going to sugarcoat it. But
Well,
that's one of the differences dealing with a mortgage broker like yourself, because you have the ability to be able to explain the positives and negatives with each rate. Does that make sense? Or with each bank?
well, the way I would put it is I don't work for the lender. I work for you, the borrower. Okay, so I've got nothing to hide.
Yeah, and that's powerful. And none of us plan for those life situations that are going to force us to take action before the 5 years. But once again, I'm always talking to my investment clients as we need a plan B. We need a strategy just in case, you do need to get out. And I guess it's the same sort of thing with mortgages as well, because, this was a great example where I couldn't fathom that somebody had to, they've had some unfortunate events in their life. They've had to make some changes and they're being punished royally.
Well, it's really bad if you can't sell your house because you're underwater. So you can't make the payments because you lost your job, and you can't sell the house because you're underwater. So what do you do? Do you just walk away and let them foreclose, and now you won't be able to get a mortgage ever again?
And the bank gets their money because they're going to sell your house for as much as they can, and they're the first ones to get paid.
And plus, if it's an insured mortgage, they come to us, the taxpayer, to claim their insurance claim.
I hadn't thought of that aspect. So they also have the ability to get their penalty, and they're in a no-lose situation.
If the mortgage is insured, they can't lose money. Yeah. So
Yeah.
So I mean, if you come to me for a mortgage, I want to know. I don't want to talk about product yet because I don't know your situation. So what are you looking for? Are you, is this your first home, your second home? Might you move? Are you planning to have kids? So we try to get an understanding of what the next 5 years are going to look like.
Yeah.
Or the next 3 years or the next 2 years. Then we start giving them options. Okay, well, if you think you might do this or you think you might do that, okay, well, here are the various types of products that might meet those needs. And of course, nobody knows the future, but let's build in some flexibility because you've just told me you're hoping to move to Vancouver in 2 years when you get the new job or whatever it is that you're hoping to do. So let's start considering the features of the products before we choose a lender. And all of a sudden, the discussion about rate is irrelevant anymore. Because they're all going to be competitive, right? Like maybe one guy's 269. Okay, so you're talking about a tiny little difference until you get to here.
Yeah. Yeah, the upfront dollar can be very little, like the monthly payment, it can be $25 a month difference. Where if somebody had planned on being transferred to, say, Vancouver in 7 years, but really got transferred in 3, and they realize that they're not going to be able to port, because what happens if, so you're moving from Edmonton to Vancouver. So you're moving from a $500,000 house to $1 million house. Is the bank just going to let you move that mortgage, even if you have to have more mortgage?
Well, you can do a port and increase.
And
okay, and so what they do there is you're still keeping your obligation under the contract. So you're still keeping that $400,000 that you signed up for. And you're still going to pay that, well, let's say the 500,000 here. You're still going to pay that 279 for the next 2 years. That component will stay intact. Now, but you need more money to buy the house. So they will tack on extra money for the remaining term. So for the next 2 years, we're going to tack on this extra money. And we'll, at whatever, some prevailing rate, which they don't tell you what it is, and you do a mathematical weighted average of the old money at the old rate with the new money of the new rate.
so if you had
a weighted average is, so, you know, usually the shorter term rates are a little bit lower. In this case, it's about the same. So in an interest rate environment where rates have been dropping, your new mortgage sometimes has a lower rate than you used to have, and you're all happy about that. But in fact, they've charged you full posted rate on the new money with no discount.
That's what I was going to ask. You probably wouldn't bet a child on one of your children on the fact that they were going to use the special offer rate.
Yeah. So, and people don't ask. They say, well, what, you know, you can reverse engineer it and figure it out yourself, but you don't ask because why? What we came back to at the beginning, you're fixated on getting the keys to that place in Vancouver.
Yeah. Well, and also, don't they also have you over the barrel where you can either pay 19 grand to get out, or you can accept our inflated rate to, you know, have a little bit more of a monthly mortgage payment, but it's easier to take than that $19,000 or $20,000 or larger prepayment penalty.
Yeah. Yeah. Well, I mean, again, you sign the contract. So once you sign the contract, I guess you could say they have you over the barrel. Like, you know, Connor McDavid signs a contract. Does he have the Oilers over a barrel? Probably.
Yeah, he'll be just fine so long as life doesn't alter. But his contract is set up in a way where he's well protected. There are those individuals that aren't Connor McDavid's that will sign a contract for way too long, and you know that the next 3 years are going to be a real burden on the team, and their life is super uncomfortable in that community because they're getting overpaid. You don't blame the player because it's the contract, but it becomes a very awkward environment where, you know.
Yeah, well, one of my favorite stories that Dave Semenko said at a luncheon one time, he was talking about his first contract and he was so excited. It was for $50,000, and the GM at the time said, hey, you know, the good news is, Dave, this is not a two-way contract. We can never send you down to the minors. So he was all excited, and he was telling Wayne Gretzky about this, and Wayne Gretzky says, you do realize, Dave, we don't have a minor team, right? So, you know, you can dress up a contract however you want to dress it up. And if you're buying a house, you usually, the first time you see the contract is at the lawyer's office.
And everybody's so excited.
The bank up front and say, give me a copy of your contract and explain it in excruciating detail to me. Nobody does that.
Well, and
so if you work with somebody like us, we're going to at least have the conversation. Have you thought about penalties? No, I haven't. Okay, do you want to learn about penalties? I can teach you. I can show you this and teach you. And then you choose you know, if you feel more comfortable going to a big bank, that's your choice. But at least understand this before you make your decision.
And so is it possible that somebody would reach out to you and say, okay, we're thinking about blending and extending, tell us about our options, and it actually becomes better to pay out that 19 and get a better rate for a longer term?
Yeah, absolutely. And well, you know, the other thing that there's a little bit of a gray area here is if you come to me with 2 years left, you're going to be up for renewal in 2 years. So Jason, you're going to be up for renewal in 2 years. What do you think the interest rates are going to be in 2 years when they offer you a new rate? And you're going to say, geez, I don't know. Okay, so there's some uncertainty there, right?
Well,
You read about it in
Scotiabank has argued that we're going to see interest rates go up every quarter starting Q2 of next year for 6 interest rate bumps in a row.
So the point being, you don't know. And so depending on your risk tolerance, maybe you want to sleep at night and you don't want to think about this pending renewal in 2 years, right? Because, you know, you've only got 1 year left on your contract, whatever it is, you don't want to worry about that at night. So then we'd say, well, why don't we start off with a brand new 7-year even, right? Then for the next 7 years, you know, you're paying 334, you don't need to worry about it. Now, what is that worth to you financially? Is it worth a $3,500 penalty? Maybe it is. So that's the great unknown, is whenever you're redoing your mortgage, what's going to be the renewal rate and when? Is it going to be another 5 years from now, or is it going to be a year from now?
And so that's something that a lot of people should think about. Now, I know Brad right now, or sorry, John, I know John right now that you guys, you and Brad are, you offer all your clients an annual review of their mortgage to basically do what we just spoke of. Would you be open to any of my clients or anybody watching this video reaching out to you and saying, hey, give me your 2 cents on where we're at?
Absolutely.
How can we try and protect ourselves if CIBC and RBC and Bank of Canada and all these people are correct that we're going to start seeing these 0.25% jumps every 3 months? Then it may be an opportunity to get ahead of this and really protect ourselves for the future. So are you open to anybody that's not your client reaching out right now to be able to?
Absolutely. You know, like I said, our goal is to help educate people about this stuff. And if we get an opportunity to do that, whether they use our services or not, well, we've at least helped them, and maybe they'll refer a friend.
Perfect. And how would you like them to reach out? By email, by phone number?
Yeah, I like phone calls or emails. Phone calls are good. You know,
Okay.
you can have a chat.
No, perfect. Then what we'll do is we will put that in the comments below. Do you also want to give us the number that you'd like them to call?
Sure. It's 780-919-4157.
Perfect. All right. Well, thanks for this time, John. There's been a lot of good information. And I know that, you know, these privileges have costed my clients. I've seen privileged payout penalties in the 30 grand mark.
Oh yeah, they can be huge. As we've seen here, on the same mortgage amount, you're talking more than 5 times difference.
Yeah. And so I agree with you 100% that anybody getting into a new mortgage needs to understand the rules of the game. So I'm glad you're there to be able to just, even if you're just the referee and explaining what they're getting into. I really appreciate that.
Yeah, no problem. I mean, that's what we do. We're you know, basically working for you. We're not working for the lender, you know, and we're here to answer all your questions and teach you as much as we can teach you so that you can make informed decisions. You know, at the end of the day, you still have to decide what contract you're going to sign, but at least we can explain to you the different options and the different types. And then if you appreciate that value add, then hopefully you'll use us to arrange your mortgage, and that's how we make our living.
Beautiful. Well, thank you for your time, John.
You're welcome. Thanks for having me.
My pleasure.
Take care.